Hello, Happy New Year to all of you. As we reflect on 2022 and all the things that happened in the markets and portfolios, we thought we would share some information and some explanations of our most asked questions. There's four parts to what we will cover, and you can skip around if you want. First, we'll go over a brief overview of bonds and how they work since they were such an attribution to lackluster performance last year. And it's essential that we understand how they function to know why we made the moves that we did. Then we'll talk about some fixed income as part of your portfolio and how an allocated portfolio did. And then we'll wrap up with equity side of the portfolio. So here we go. I'm going to start sharing my screen and some charts that we think will help us guide us through this. So first, we're going to talk about bonds and valuations. In order to understand what's happening in your portfolio in a fast raising rate environment, it is worth a refresher on how a bond is valued and how interest rates affect the market value between when you purchase a bond and when it matures. So if we wanted to pick an example of one bond that we paid $10,000 for, so this reflects a $10,000 payment that we're going to loan a company that has a 5% yield. So we're going to get $500 given to us semi-annually for, let's just say, 6 years. So you lent $10,000 to the company. You get $500 every year for 6 years. And then at the end of 6 years, you will get the $10,000 back unless something happens to the company that they cannot pay for that. So as for valuation of that bond, as interest rates increase, the value or the prices of a bond decreases. So, for example, if in the first year nothing happened to interest rates, this is the valuation of this exact bond. If nothing happens in that first year, the bond value will still be $10,000. If rates happen to go up, let's just say by 2.5%, your 5% bond, so now rates are paying 7.5% and you are holding a 5% bond, the value of your bond is going to go down because uh, essentially people don't want to pay for a 5% bond when they can get 7.5% elsewhere in the market. So the value on paper and the market value goes down. Hence, interest rates and prices are inversely related. But the market value doesn't represent the long term inherent value to your portfolio. So if your $10,000 bond's market value drops to this red line, you still own a bond that's going to pay you back $10,000 when it comes to maturity. So every year that you hold on to this bond, or every month, every year, you start to gain value back that you lost in the very first year of rates hiking and the value going down. You will get it back as you get closer to that $10,000 maturity. So recognizing that our allocation to bonds in a rising environment provided negative performance last year for a short time frame, they will still attribute to your long-term portfolio value, and it continues to add safety because the $10,000 that we lent this company will get paid back to you. It is owed to you, unlike the stock market. And this is valuable because even if the performance in that interim doesn't reflect the true maturity performance, you will get it back as time goes. So it's good to note that this process has very little to do with the stock market, but it has much to do with how fast the Fed had to move interest rates this last year. Also, keep in mind that if the Fed at some point cuts rates, then the opposite will happen in bonds. They will gain in market value for a stint. So if they cut rates, the value of your bond would go up because you're holding a 5% bond. And if they cut it to, say, a 3%, you'd be owning a bond that people would really covet. As you get towards maturity, they would covet it less, and you eventually get back to the par value or $10,000. So with higher yields, bonds will be providing much more attribution to your portfolio going forward, and we will not have to take on so much risk in the equity markets for that nominal yield. Hopefully, that helps you better understand why we hold a core bond portfolio in your allocation. Next up, we'll talk about fixed income as it relates to your portfolio. As we look back over the investments in 2022, it's more obvious that the major effect on portfolios had more to do with the bond market than it did with the stock market, which, as we're going to show you later on in this presentation, is incredibly abnormal. Typically, I would call it like a sleeper asset class. It wreaked havoc on short-term portfolio returns. So we're going to go over what exactly happened. The Fed has a really tough job. It has a tough job of keeping balance of interest rates and the economy and keeping that in sync. This slide is a representation of the Fed funds rate since the year 2000. The Federal Reserve has had to keep short-term trading rates almost near zero for the better part of a decade. Back in 2018 and 19, they tried to hike rates up until the pandemic. And as you can see in this chart, they were able to perform a very beautifully laid out incremental rate hike cycle. While bonds and stocks didn't care for this, they still held up pretty well. In contrast, if you look at the hike cycle in 2022, it looks nothing like the controlled approach that happened in 2018. It's very, very fast, very, very steep. The Fed got behind the ball and they had to force some very large interest rate hikes upon the system, of which it wasn't ready to absorb. And that voracious hiking was the fastest rate hike on record, and the bond market had much more swift and severe reactions to it. Hopefully, you were able to watch that portion of our short video on how bonds are valued because it'll help us understand that how Caissa was positioned going into 2022. In short, increases in interest rates will decrease the price at which another buyer would want to pay for your bond. So if you wanted to sell it, if you don't sell it, then the value for you is the face value of which you lent the company and that they owe you back. That's the face value. In our example, it was $10,000. This chart is a depiction of how shorter bonds had better returns than longer bonds when the rates were increasing. So if you look back to 2022, shorter bonds were hit less hard than if you held a very long-term bond, which we have seen some long-term bonds being down 30 and 40%. The amount the company must pay you back, it doesn't really change. So in the interim, the market price, which is what you're seeing on your statements right now, is what fluctuates daily. And it fluctuated to a much lesser extent on shorter maturities than longer maturities. With the shorter maturity, there's less time you're stuck holding that lower rate bond to mature than, say, this 30-year bond. As we went into 2022, Caissa had overweight the fixed income portion of the short end of fixed income. And we were holding most of these maturities in this 2 and 4 years right here that the US aggregate has. Thankfully, because now that the rate cycle is near the end, we have flipped out and we started buying up some of these longer term maturities that have been beaten up so badly. And so we will not only buy them at a lower price, we're also going to be getting a better yield. So we're really excited about this as a strategy for the next market cycle because your bonds are going to be working much harder. They're going to contribute much more so that we don't have to rely so heavily on that stock portion of your portfolio to provide returns with the risk associated with those stocks. If we wanted to try and put it in perspective, what just happened? The bond market being down double digits in 2022 was a once in a 90-year occurrence. The last time that happened was 1931. To say this is an anomaly is an understatement. Also of note, since 1976, and that's what this chart is depicting, the worst return for the bond market was down 3%. So we had a negative 3% here, -1, -2. That has only happened 6 times in the last 50 years. So it happens very rarely, but take a look after each one of these downturns and see the upside in the year following. Typically, it's almost often followed by a significant upturn. The thing is, it just doesn't feel good to see that our safe assets have lost value, even when there's short-term pricing issues. We haven't had a significant and prolonged downturn in the market since 2008. So we just needed bonds to finally show up and provide some value. And they did the opposite last year and provided a negative attribution, down 13% for the short-term performance. Remember, when held to maturity, the current pricing effect of last year will be of little to no consequences. So this is why we're not quite as distraught over this print on paper would make us probably feel, because we understand the underpinnings of what the bonds are going to do for us in the future. So how does this affect our portfolios and as we have built them today? 2022 is going to go down in history as for a number of market anomalies. This chart is a chart of all annual bond returns versus stock returns all the way back to 1926. We just entered onto the books a first in history. The first being 2022 is the first time ever the bond market and the stock market were both down double digits, down 13%, down 16% here. Only a couple of other times in history have they both been down, only 3 other times, but this is the first time ever that it's been double digits. And the last time that the stock market was down, it was 1931, and it was only down 5% versus down 13. So again, this is a once in a 90-year type of anomaly. Regarding your portfolio, to put it in perspective, this is a graphic of major asset classes and how they performed year to year since 2008. Additionally, this is a depiction of how a 60/40 portfolio typically maintains more stable and reliable returns. They're staying, if you're ranking all the asset classes, this asset allocation typically stays pretty stable in the middle here, giving you pretty stable returns. Fixed income, if you look at the 2022 and which asset classes performed, fixed income as an asset class was down double digits thanks to an unprecedented fast rate hike cycle by the Fed. There were not a lot of places to hide. The only asset class that held a positive return was commodities, and that was helped by a Russian invasion a little bit. If not only for cash being the other asset class, every other asset class was down double digits, including fixed income. So, on average, depending on the source, a 60/40 portfolio was down about 14% in 2022. Even if we had had clients in all fixed income, you would have still had a portfolio end up down the year, probably around negative 13%. So, again, we want to stress that there's a vast difference in having your market value of bonds being down double digits than your stocks being down double digits. With an understanding of what happened to the bond market and knowing that we can accrete that value back and hedge our portfolio, we know that bonds will still curb the downside of our portfolio because we know we will get the value of the bonds back. Whereas the stock market is going to have to earn its way back. And we don't know how long that will take because that's not an obligation. We know when bonds will get their value back. And that's why they're still our safety asset. They still have a place in our portfolios. And if you're still contemplating your allocation to fixed income and are thinking about capitulating, take a closer look to this graphic. It charts out the last 70 years of the 60/40 portfolio and what fixed income and stock market attribution to the portfolio return versus bonds represented. The bonds are represented by gray here, and the stock market is represented by green. And so of the 18 or so times that the stock market was down in the last 70 years, and so any of these negative years, the bond market was positive. So all of these red circles represent what the bond market did that year. And for the most part, when the stock market was down, the bond market was positive. Only 3 times was the bond market also negative. And so bonds do help curb the downside of your portfolio in almost 100% of the time, except for 2022. And then if you look at all the years following these downturns, which is represented by blue, they have significant upturns after a negative stock market year. And so 2022 is a Fed-driven anomaly, and the bond market will bounce with good management. So we're taking advantage of the hardest hit maturities and buying them up as our strategy. One last point to consider to remind ourselves about volatility. We have not felt the significant and prolonged volatility since 2008, and it's wise to review this concept of the graph of what this graphic is trying to show us. Given a 1-year time frame, the stock market, represented in green, has moved anywhere from a negative down 39% to up 47. By adding in some fixed income, though, this bandwidth was much contracted and reduced to a worst 1 year of negative 15% and a best 1 year of positive 33%. That's a pretty wide disparity of just adding bonds to your portfolio and pulling in that volatility. If you review the exact same 2 portfolios, but then rolled them out for a 5-year rolling period, the worst year for a stock portfolio is negative 3%. And the worst year for an allocated portfolio was plus 1%, with the upside being 21 to 28% ranges. As time goes on, those bandwidths contract even further. And the bottom line is that bonds do thwart volatility, not always in the case of a Fed hike cycle. But our job is to put together the right mix, support your financial plan, and then not let fear and greed get the best of us when the market is having that 1 year volatility. This is what will allow for us to have those 5 year rolling numbers come to reality. Portfolio analysis. We've had some conversations with clients, and we thought we would highlight some do's and don'ts. What should you review? What should you be aware of when you're looking at your portfolio? First off, is we wanted to remind people to what the difference of going to Schwab online versus the Schwab port or the Caissa portal. Schwab, when you go online, represents balances, and what's happened to that balance. It's not performance, and there could be withdrawals and additions to that balance that are vastly different than performance. So we really urge you to go to the portal for anything performance related. Schwab, I would go there for more administrative things versus if you're going to look at a portfolio assessment, the Caissa portal is the place to go because you'll be able to see 1 year numbers, 3 year numbers. They will be net of fees, net of all contributions and withdrawal rates. Then Schwab also is, if you want to look at your positions, that's fine. But if you want to look at anything that's portfolio, allocation, or tranches, you'll definitely want to go to the Caissa portal. Couple of the other things to remember is timeframes. If you're comparing and reporting, to always make sure and compare using the exact same dates. Even using 1 day off or a week off, we have market swings that are 1,000 points these days. So if you aren't using the exact same beginning and end dates, you're going to have apples and oranges types of comparisons. Also, just knowing that the last 12 months versus last 1 year versus the calendar year, they're not all interchangeable. They may have different reporting dates, so keep an eye out for that. Huge other point is when you're looking at performance reporting, knowing cumulative and recognizing that versus annualized. For instance, if you had years 0 to 5 and you were just taking the beginning balance to the ending balance, you might come up with a 50% gain. If you are taking year 0 to year 5 and you come up with 50% gain and you want it annualized, then you take that divided by 5. Therefore, you'd have a 10% annualized gain. And if you try to compare the two, it's apples to oranges again and could vastly throw you off. So, and then lastly, making sure you're looking at your benchmarks and that you're comparing, not all indexes are alike. Comparing the S&P 500 to a bond or the bond aggregate to a small cap stock is just apples and oranges again. So quick tutorial on things to look out for. Lastly, we're going to wrap up on the equities and just try and go through a really quick synopsis of what's happened in the market in the last few years and where we're going. Just to put things in perspective again, recovering from the 2008 global financial crisis, markets have just experienced one of the longest bull markets. It spanned over 133 months, and the S&P 500 had a 400+% return. And that happened about right here before COVID happened. And COVID happened right here in this little dip. Then we broke the streak and we had 34% downturn in a matter of a few months. But then we gained it back and we roared up another 100% from these COVID lows once again. So we've had a heck of a run in this bull market. But to keep it in perspective, on average, the market is supposed to pull back 14% every single year. And it's done that for the last 40 some years. And of those 40 some years, 30 of them, so 3 out of 4, always ended up positive. But 1 out of 4 is typically a negative year. We have not had a negative year at a prolonged rate, minus COVID, since 2008. So that was the last prolonged downturn that we've had, minus this really quick COVID stint. So we knew that the Fed was keeping the party going artificially with very, very low rates, and the market really liked that. We all knew the punch bowl was going to be taken away, but what we didn't know was when. And the Fed they weren't quick to move. So we were in this bull market that started to be very much artificially propped up. And to get into it as to what Caissa was doing, we had a growth and a value play, right? And so what this graphic is showing us is the dispersion of growth stocks and value stocks. And the bull market was largely driven by growth stocks, which had a phenomenal run. Relative to the value stocks over the past 10 years, it was returning almost 4% more per year than the value stocks. And during those years, due to the 0% interest rate environment, Caissa was positioned double weight growth to value. And many portfolios experienced exceptional double-digit growth returns for the last few years consecutively. So stocks are reasonably valued again as we bring that zero rate environment to an end, and we have a lot of that stimulus still out there. Investors were paying a very big premium to get into growth, and they've just decided, hey, we're not willing to pay those premiums anymore, and so essentially we pulled back and we're resetting the valuations of those growth stocks, and they came crashing down in 2022. Stocks right now maybe not screaming cheap or yelling that we should buy them yet, but the valuations are at least more in line with 25-year averages than where they were up here at the highs. When we talk about what's driven the market in growth stocks, there were 5 stocks, and they were part of we call them for short term as FANGs, and it was a lot of the Facebooks type of stocks that were included in that. And just 5 companies made up nearly 20% of the S&P's market cap. That's exceptional because the value of those 5 stocks grew to such highs that they significantly outperformed the rest of the market and especially coming out of COVID. Their expanding market caps, they led to they were the extreme concentration of the S&P 500, and their tremendous growth, coupled with looming raising rate environment, led us to begin shifting portfolios beginning 2022. That we, instead of having that double growth to value, we then made more equal weighted growth to value calls, just because we felt like this was getting much overheated. So where do we go from here? One thing to note is that the market is already pricing in that the Fed will likely possibly overshoot, and they might start bringing back down that Fed funds rate going into the next few years. Therefore, bonds and stocks alike they'll like this, and this would be a positive movement. So what we're trying to do right now is own the stocks that we want to have that would prosper in this environment where the Fed funds rate stops hiking, slows down, and possibly retreats. So that's one of the strategic moves we're looking at. The other thing to remember is being fearful when others are greedy, and greedy when others are fearful. And that's a Warren Buffett quote. And so we're looking at consumer confidence a lot and just looking at the trends of saying when consumer confidence is at its lowest, it might be the wisest time to start putting money into the market, because there tends to be a large upswing after consumer confidence gets beat up pretty low. Sentiment was pretty optimistic through 2021 and 2022, or 2020 and 2021, as markets experienced these all-time highs. But history shows that investors are emotional, and they usually overreact at the worst times and get out down here. So when investor sentiment becomes overly bearish, the forward returns for the S&P 500 are pretty attractive, and we believe it's a critical moment to remove those emotions, stay disciplined in our portfolios and our strategies, and make moves only if it fits our long-term objectives. Caissa has been and will be adjusting portfolios to lean into areas we think are fruitful and will reduce areas that we think may not be so fruitful. That all being said, if you have any questions, please do reach out to us. We would love to have those conversations and try to work through anything that's on your mind or things that you're thinking about and feeling. So please do reach out and give us a call.
Please check out our website for more information and videos.